Chief Market Analyst here at Scope Markets, and this is your daily briefing. Markets in Asia continued their solid gains for the week as investors' uncertainties were eased from the fact that coronavirus lockdown in some parts of the world was starting to be loosened. This also helped oil prices jump on the expectation that we could see a rise in demand. It was a risk-on scenario for markets, with those riskier assets, including equity markets, continuing to rally, which has of course been helped by the adding of yet more stimulus by the Fed, the US and the Bank of Japan. However, we must be cautious around the market rally that has seen markets relentlessly push higher since the end of March. Stocks may have recovered, but there is still growing unease about what the overall economic damage will be once the dust of coronavirus settles. Today we'll see an indication of that as we get the release of the US preliminary GDP reading as well as the core PCE inflation reading. Market expectations are that the economy has in the US contracted by around 4% in the first quarter. Earnings season has shown this, as many companies have warned that the future is looking very uncertain. However, investors have been unwavering in their support of the major indices. However, from a technical standpoint, many of these stocks remain below their key moving averages, something that points to many of them remaining in a downtrend. This morning has seen news that the UK banking giant Barclays' profits have fallen by 38%. The bank also said that it had set aside up to £2.1 billion to cover for bad loans and defaults related to the COVID-19 outbreak. The news from Barclays comes after British Airways owner IAG yesterday announced they would be making up to 12,000 members of staff redundant in a bid to survive. Oil markets have been steady overnight in Asia on the fact that easing lockdown will mean that demand will likely start to pick up. However, how quickly is the key point. The oil industry wants to avoid another scenario that sees prices drop into negative territory. If demand starts to pick up, it means that the glut of oil stored can now start to be used. However, it's likely that demand won't pick up enough before the expiry of the June futures contract to keep away another huge plunge in prices. It's estimated that the oil industry could see 30,000 jobs lost due to this crisis. And today we'll also see the big headline of the FOMC Federal Reserve interest rate decision. In the US, policymakers will look to decide if they have added enough stimulus into the economy in order to navigate its way through this crisis. Since the start of March, the Fed have pledged to pump over $4 trillion into the economy. Now, we don't expect to see more rate cuts from the Fed today. It will more be their outlook for the year and beyond that will be of interest. Before the Fed announcement, we'll see the GDP reading, preliminary reading, which is expected to show a 4% contraction in the economy. We want to know from the Fed how long they expect rates to stay low for, how low could GDP fall, and whether they will be taking any further steps to prop up the stricken economy.